Looking at the Markets with David Modell. Welcome to Looking at the Markets with David Modell. Today I have the pleasure and honor of speaking with Mr. Kirk Spano. Kirk Spano will be speaking mainly about oil and gas today, but he has expertise in many areas. Now, just for a quick introduction, hailing from Milwaukee, Mr. Spano, after college, began his investment career as a financial advisor back in 1996 with one of America's largest independent broker-dealers. Then spent 14 years as a broker, restrained, unfortunately, by a financial industry that he feels is mediocre at best and generally overpriced. I tend to agree with that. In 2010, Mr. Spano founded Blue Mound Asset Management, LLC, a fee-only registered investment advisor in Wisconsin. And in 2011, he was selected over nearly 200 analysts as the world's next great investing columnist by none other than MarketWatch, which is owned by the Wall Street Journal. And now he's joining me on Looking at the Markets. Thank you, Mr. Spano, for joining me today, sir.
Hi, David. Man, I'd listen to that introduction over and over and over again just to make myself feel better.
Great for self-esteem. And,
oh, yeah. Wow.
But it's all true, though. And yeah, you're certainly free to talk about whatever you like here on Looking at the Markets. But today we agreed to focus on something that's really exciting for me, which is oil and gas, those particular industries. For example, just generally speaking, oil has been range-bound. Natural gas, it's hard for me to find a direction on, so perhaps you can present us with some insight into that today. But if we could just start with a little bit of, I gave a little bit of your background, but what got you into finance and investing in the first place?
Well, I've used this joke before, so I'm getting better at the delivery. I actually was going to be an attorney, and I had a great uncle who started to talk me out of it. I decided, well, yeah, I don't think I want to be an attorney. As my uncle told me, it's kind of a dirty business. So I got into finance instead.
I'm glad you went in that direction. Nothing against attorneys, but what you're doing now is truly helping people and disseminating information that we can all use. So I wanted to focus, and we're going to talk about your website, which I see that you're on right now. But just real quick, if we could talk about a couple of your Seeking Alpha articles before
Sure.
we get to the services that you offer, which are super important. For example, I was just going to go to that one actually first. Shale never was OPEC's primary target. Really, you'd think it would be. So how do you explain that bold statement?
Well, I was picked to be an analyst with MarketWatch for really one reason. It's that I called the oil boom, the shale boom, before almost anybody else. And within weeks of me calling that boom, Citigroup and Goldman Sachs came out with reports saying the same thing that I did, which is that shale was going to be a game changer. But the reality of the long term of oil runs into a couple of major problems. The first major problem is we will eventually see electric cars.
Yeah.
And since oil is half of all oil is used for automobiles, eventually there's going to be huge demand destruction. When does that come? You have the Uber bulls on oil saying, it's not going to happen until the 2040s or 2050s. I think they're out of their mind. Then you have other people who say it's going to start in 2 or 3 years. I think they're out of their mind. The reality is that it's somewhere in between. Eventually there will be a announcement or a PR from somebody who, maybe Tesla, and the PR is going to go like this. We now have electric vehicles that cost the same price as a gasoline-powered car. They go about 400 to 600 miles on the charge, and they don't really take as much maintenance cost as the gasoline-powered car. When that PR comes out, that'll be the real tipping point for gasoline and oil. And when it comes, you better have an exit strategy on the oil stocks, because it's not terribly far away, 4, 5, 6, 7 years, something in that range. That's where the technology is going. the reason why shale isn't really the target of OPEC is because shale is a short-range oil solution. It doesn't cost terribly much to produce an oil well with shale. When I was first out in North Dakota in 2012, it was about 11 or 12 million, maybe 13 million to do a well, and now they're down to half that. So the cost of shale isn't terribly overwhelming. So attacking it when it's cheap to produce at this point with the technological improvements and the fact that it produces most of its oil in the first few years doesn't make a lot of sense. So you start asking the question, what really was OPEC trying to destroy? And it's clear that they were trying to kill the mega projects that were out there. A mega project is either oil sands or offshore oil, and those projects take huge upfront capital investments. And they take many, many years for the investors to break even. So if BMO or JP Morgan or Exxon or somebody finances an offshore project, it might cost $100 million or $150 million or $200 million or many, many cases even, into the billions of dollars for some of the giant projects. And if they're not going to make their money back for 10 or 15 years, and they know that PR I was talking about is coming, why would they want to build those projects? Well, OPEC realized that, so they were like, well, let's make sure that since we already have the cheapest oil, let's destroy the mega projects that are potentially going to get built in the late 20-teens and the 2020s, so that we can sell a whole bunch of oil into a supply challenged market. And that's what they're setting up for. Is they've destroyed over $1 trillion of investments in mega projects. I mean, that's not a small thing. We are already in balance in the oil market. There's a huge inventory out there, but the supply and demand are just about equal, and that is before we go into the summer driving season. Yeah. So starting this year, probably next month, we're going to see demand slightly outstrip supply. As those mega projects in the deep water, take a look at anything in the North Sea, produce less oil, and they decline at around 8 to 10% per year. If they're not being replaced by other mega projects or other offshore oil, who's going to fill that gap? And people say shale. Well, that's probably not true. I have quite a few statistics in here and a couple of charts. And this one right here shows offshore oil is about 29-30% of all oil produced. If that's going down by about 10% a year on gross, and then maybe half of that is replaced by projects that were already in the pipeline, you're looking at about 1.5 million barrels a year of offshore oil that's going to come offline. And that started this year. So in 2017, 2019, 2020, you're going to see 1.5 million and increasing over time barrels of oil come off from offshore. Shale can't replace all of that. Now, I know that guys like Harold Hamm are out there saying, hey, we can produce 20 million barrels of oil if we had to out of the United States. That's garbage. Take a look at Harold Hamm's track record. He was a great wildcatter, but since the market changed on him a few years ago, he really hasn't gotten anything right. He took his hedges off at $80 a barrel, and he bragged about it. Oil went to, 26? Yep. So, the guy's not a good forecaster. He's a great driller. He built a good company in Continental Resources. I've met the guy. And, he bought me some eggs and bacon one time. Yeah. But, the reality is that shale has limited capacity. You can check the EIA on this. The highest it will get, probably, and I think I have a chart in here somewhere. Yeah, I just played with the Y charts here. 10 to 12 million barrels a day is what shale is going to top out at. And then it's going to fall back down over time. So in the 2020s, we'll probably peak on shale production around 2020. I think the EIA says 2022. It'll be in that range. You know, you can't try to be too perfect. You just try to be real close. And from that point forward, shale is going to fall off because A, it'll get more expensive, right? Because they're drilling the cheapest, easiest to get to shale oil right now. So as they deplete those resources, they have to move out to the tertiary plays, you know, the secondary plays, and those are more expensive to get into. And then on top of that, I know that we run into ideology here, but the reality is that there's a very strong environmental movement, and they make some very, very good points. They're going to start blocking certain shale plays, those that are close to the cities in particular, those that are on major water reservoirs. So, you know, there's certain shale that will never develop. There's other shale that just isn't worth it. So how long can we produce 10 to 12 million barrels a day? Not long. 6, 7, 8 years maybe. You have to remember the depletion rate on a shale well is very fast. It's 2/3 done after 3 years.
So this all adds up to what kind of outlook are we talking for a long-term investor? I mean, what do we? How do we make this actionable? Is what I'm asking.
Well, okay, so long term to a lot of people is 2 or 3 years.
Yeah.
To me, that's intermediate term. Long term are the giant secular trends that are in place, which are that technology is going to change everything, and consumer behavior is gradually evolving to adjust to new opportunities, to new lifestyles. And let's face it, the millennials aren't going to live the way that the Xers did, who only, you know, partially lived like the boomers did. But there's this evolution going right now. So for a long-term investment, oil's not the place to be. But for an intermediate-term investment, for a 3, 4, 5 year position trade, if in your head that's long-term, then go ahead and do that. You know, to me, that's an intermediate-term trade. So I've been writing articles like this, telling people how to get into this beaten-up oil and gas market, which bottomed out last February 2016, I should say. Right. Rebounded pretty tremendously through the third quarter of last year, and has been soft now for what, 6, 7 months? Yeah. And it's just starting to turn back up as we go into the summer driving season, and now that OPEC and Russia agreed to restrain production. And in a second here, we'll get to a wild card on oil. But I think that for most folks, some of the companies that I focus on in here, we'll get down here eventually. So you got these 3 companies: ConocoPhillips, Occidental Petroleum, and Cana. Those are my 3 favorite oil stocks to buy because they all have good assets, including in the Permian. Occidental is the biggest producer in the Permian, and Cana has 10,000 potential well locations. They've done a good job refocusing their business. ConocoPhillips, to go back to the death of the mega project idea from the start, they've already sold off their Canadian, a lot of their Canadian oil sands. That was a big news, a month ago? And last year they canceled all deep water exploration. Conoco. You know, Conoco's a big company. For them to do those things, that's a harbinger. That's a signal. That should let you know that that's not where the long-term money is. So, you know, they're going to exploit their shale, and in my opinion, Conoco has the best management in the industry. I mean, I guess there's some arguments there, but you know, to me, they're really very, very good. They understand that they should be selling into the oil strength. So they will be selling off a lot of their assets over the next several years, and then they will transition into some other type of company. They are the third or fourth largest natural gas producer in the country, and natural gas has a much brighter future than oil. Natural gas is a long-term investment. It's going to be around 30, 40, 50 years. And it's going to continue to drift upward in demand because we don't want to use coal anymore. And that's probably a great decision for not only the environment, but the reality is that natural gas is, just it's easier to transport. You put it in a pipeline, and the United States can export it, so much easier. So I think that we're going to see natural gas do very well with the slow death that will eventually become sudden of coal. The coal rebound is a fallacy, and you're going to see one of the greatest shorts ever when coal is ripe to be shorted again in the next few years. Donald Trump obviously is propping that up a little bit right now.
Right. Quick disclaimer, if I may. Nothing we're saying in this video is advisement to buy or sell anything. Everybody has to do their own due diligence and consult with a licensed, registered investment advisor before making any investment or trading decisions. However, I really like those three companies that we're looking at now: Conoco, Occidental, and Kana. Yeah, very good. Now, I just wanted to go to your website. Want to spend some time on that, if you don't mind.
Sure.
That is fundamentaltrends.com, and I'm going to put that link in the description. There's so much on here. You got some free content as well as some things that you offer for people who want to get serious about investing and want to tap into your wisdom and insight. So what will people see on your website?
Well, I do every Friday I just put out a blog, and I've decided to be a little bit more free-flowing on those blogs because, hey, I own it, so I can do what I want.
Right.
And I think that what people will get most out is a good top-down view.
Yeah.
So I have a process, and this report's going to be redone. But the process really talks about asset allocation and how to find a core investment. Or how to have a strategy for finding investments. I call it Core 4 investing. I've stolen this from other people, bits and pieces, and put it together.
Sure.
But really, we're looking at 4 things that really drive all investments. This is what I've done to be ranked top 1, 2, 3%, whatever it is I am on a given day.
Yeah.
We want to look for the big secular economic trends. We want to look at what the governments and central banks are doing. We're going to take a look at the bottom up of individual companies and sectors, and then something that I think you're pretty in tune with, price trends, right? We want to know, roughly what the price trends are. I use a couple of different quantitative screens and then some very basic technical tools, just to help me avoid, accidentally trying to catch a falling knife.
Right. Combining fundamentals and the technicals. We're combining all these to make, to find some fundamental criteria for when do you enter and exit a trade or investment. And I really like what you have to offer. What are the premium services that you offer?
Well, I do have a subscription service. It's I can't show it because I'm logged in right now.
Right.
But for $199 first year, that's a 50% discount to the $399 per year ongoing price. You get all my stock picks, my ETF picks. I have a real nice breakdown, something I call the very short list. It's about 60 companies that if the price is right, you should jump in on them. And that's really what I stick to. I think that one of the mistakes a lot of people make is they're constantly shopping for that next great idea. And you know what? That's just so hard to do because you end up missing so much, and just being wrong and getting involved is difficult. So controlling your emotions, having a list, and going back to that list over and over and over again, and occasionally adding to it, but knowing in and out the companies that you might invest in. So, I have to admit, I'm writing an article right now about all the companies that were on my list that I never invested in.
Right.
You know, I told everybody about PayPal when it was $30 a share. What is it now, 45? And I haven't been in it. Told everybody about Micron when it was 8, 9, 10. I bought a little bit. I sold it at 18 and went to 35.
Yep.
You know, those are lessons that you know, investors just have to keep coming back to over and over again, and that's where this price trends. I didn't used to use the price trends, but I kept getting out too early.
Right.
And I was like, okay, well, where do I figure out how to stay in just a little longer to catch those parabolic end moves, those exhaustion moves?
Yeah.
And so I've you know, I don't do this analysis myself, actually. I just subscribe to two professional services, and then I share the information with my subscribers. And it's been remarkably effective. We're up like, you know, because we have a big investment in exact sciences, we were up about 60% last year. And now that oil and gas start to be moving, you know, because we took it on the chin a little bit in oil and gas the last few years. I got out. I wrote an article on MarketWatch in June of 2014 telling everybody to get out of oil, and then I got back in way too soon. And so I got beat up a bit in the second half of 2015. But, you know, I would say, I mean, after you create your universe that you want to invest in, which is the left side of the sheet, then you use the price trends to try to figure out when to buy and sell. And I'm a position trader. There's very few things that I don't hold for at least a year, and most of the investments I hold are 2, 3, 4, 5 years. A company like Exact Sciences I've owned for 9 years now. I'm up 2,000%. I'm not going to complain about that. I mean, anybody who tries to tell me they're trading, well, you know, you tell me how you beat 2,000%, and I'll start trading the way that you do.
Exactly. Very nice. So wanted to talk about, and we'll come back to that, but you have another article up there, you know, for people who are not necessarily stock pickers. I love a good ETF. It you know, why not buy the whole basket of stocks if you believe in a sector as a whole? But which ones? Now that we possibly have rising oil and natural gas prices, what are we looking at for ETFs?
Right. So there's a simple theory that I learned from, you know, watching Michael Price back when I was younger. Michael Price sold the Mutual Series mutual funds to Franklin Templeton. He was, you know, one of the first guys to sell something in the financial industry for $1 billion. And they focused on value and then catalysts to unlock that value. And the service I'll be introducing on Seeking Alpha, if you want to go in that direction, is going to be called Catalyst Investing, because we want to see value unlocked. Well, one of the places where we're starting to see value unlocked is in the oil and gas services ETFs. And there's a particular ETF that I like better than the others. You can see I like playing with Y charts, all the pretty colors.
Sure.
But the XES, the Spider XES, X-ray, let's see here, right here, ETF. I like this one a lot. There's a high correlation of oil prices to the oil and gas services stocks. In fact, it's actually just a shade higher than the correlation with the actual oil and gas production companies. So the service and equipment companies should do better than the oil and gas companies if oil and gas indeed go up. And then there's a kicker here. President Trump, and I think the Republicans too, who control Congress, really wants to see the United States make a lot of money on oil and gas while they can.
Sure.
So that's going to be good for our service and equipment companies, even if the price of oil and gas doesn't go up dramatically. And I'm forecasting that it will, and I'll tell you why in a second. The oil and gas producers will still do pretty well because we're still going to try to produce that 10 to 12 million barrels of oil per day, and we're still trying to export natural gas. You know, the Sabine Pass facility down in Louisiana came online last year. we're exporting about 4% of all the natural gas we produce right now. And by the end of this year, with another terminal coming online, we might be up to 7 or 8% by the turn of the year. And there's a couple of other terminals that are under construction that should be done in 2018 and 19. By 2020, we might be exporting well over 10% of the natural gas that we produce. Well, here's the interesting thing. The reason why natural gas prices, I know you asked about this earlier, have gone up is because we have exported 4%. The supply overhang had been, when natural gas got down to $1.50 for a little while per million British thermal units, was about 3%. So we were producing 3% more natural gas than we used. Well, now we're exporting 4%. Our natural gas production hasn't changed in the last 2 years. So we're actually slightly in a deficit on natural gas produced versus used or exported. And that equation is just going to keep getting tighter, maybe go into deeper deficit. So we're going to see natural gas prices drift upwards towards that $4 per million British thermal units. It's at about 3 right now, up from $1.50 a year and a half ago. So, natural gas prices are going to drift upwards. Oil prices, though, just to jump backwards again, oil prices I don't think are going to drift upwards. I think we're going to see this little drift here. But long time ago, I worked with some geopolitical teams that wrote papers for think tanks, and so I have a pretty good background on the geopolitical side. And if anybody ever really wants to get good geopolitical information, go to a website called Stratfor. And I will tell you, I think they run specials, this company. I think $99 I think you can subscribe to this. If you want a really good insight into what's going on around the world, subscribe to Stratfor. You just really are going to have a hard time finding better information. And they are forecasting some things that I agree with, that I've been saying. And one of those things that's going to drive oil prices up is there is a greater conflict coming in the Middle East. And I don't know how many people think about that real deeply, because you really don't want it to happen. But I think that the reality is pretty simple. Saudi Arabia, which just cut off Qatar, and the Gulf Cooperative Nations, and Jordan, and Israel, and the United States are all lining up against Iran. And at some point, there's going to be a conflict with Iran. And I don't know how exactly that will manifest. I hope that there's another attempted revolution there that we can support through, taking out their military and letting them go after the mullahs and the Ayatollah. Because if we go after the mullahs and the Ayatollah, we're the bad guys again for another generation of people. So it has to be internal in Iran. And I think that day is coming. Here's the thing. When that conflict occurs, and I'm saying when because I think it's 90% likely. I don't even think there's a much reason to think that it wouldn't happen. Right. You're going to see the price of oil jump pretty high because there will be a missile, or there will be a rebel group, or there will be some action that knocks out some of the Iranian production, and in particular the transportation infrastructure. So even though they may still be able to drill all the oil they want to and natural gas they want to, they blow up a pipeline and a refinery, a port. Right. And how are they going to get it out of there? Yeah. And I hate to point to things that people might label as conspiracy theories, but we did just cut a deal with China to export natural gas to them. So Iran already exports natural gas to China. Well, there's different ways to get market share, and some of them are dirty. So, I think that realistically there are legitimate reasons to target Iran because they're maybe the largest state sponsor of terrorism around the world. They've broken really every deal they've ever made with the West since 1979. They're probably still developing nuclear weapons, on the down low, or, they have a relationship with North Korea. North Korea is developing nuclear weapons. What would it take for North Korea to sell a few to Iran, right? So Iran can get around the nuclear sanctions by just having Korea act as their proxy for development. So, I think that when the conflict with Iran happens, you probably see the price of oil jump up to near $100 a barrel, from 60 or 55 or 65, whatever it is at the time. And that is going to create this short window, this 3, 4, 5-year window where OPEC's oil from Saudi Arabia and our oil from shale does very, very well. And that means going back to the service companies, you're going to have some ETFs that do pretty darn well.
You mentioned XES. There are a couple others I see there. OIH, which is very well known. IEZ, not as familiar with that one.
It's similar to OIH. It's almost the same setup.
Okay.
So the VanEck Vectors Oil Services ETF OIH, which used to be Market Vectors, that's market cap weighted. So you're very huge into these companies: Schlumberger, Halliburton, Baker Hughes. That's 35% of the fund.
Right.
I don't like Halliburton at all. I think Halliburton, because of the broken up deal with Baker Hughes and just because of some other things that they've done, Halliburton doesn't deserve a good valuation. Schlumberger does. I really do like Baker Hughes. What I'm doing is I own XES, and then I own a little bit of Baker Hughes. And that gives me the exposure I want because the Spider is equal weighted.
Right.
So you've got about 40 stocks in there, give or take. Let's see here, 36 holdings. They're all around 2-3% of the portfolio. So you get a better mix. And the smaller oil and gas services companies, they're much more levered to increasing demand for their services and rising oil prices. It takes a lot to move the needle on a giant company like Schlumberger or Baker Hughes. I do think Baker Hughes has some advantages, which is why I'm in there. Halliburton, tell you what, man, I think Halliburton's going to have a long, difficult road to hoe, and just don't think there's a lot of upside there. So why would I want 10% or 11% of my fund in it?
So we're talking about XES, and then just to weight it a little bit more toward Baker Hughes, pick up a few shares of BHI possibly. That could really be advantageous in what you call the short window, which is 3 to 5 years. I don't call that short, but from your perspective, you're looking out decades, and so that is a short window, and you want to be in there before it happens. That's the idea. Yeah.
Right. I mean, just going back to this general idea is your big secular macro trends, your top-down stuff. I mean, those sorts of things play out over many years. Right. And then in the intermediate window, you have the government and central banks, taking different actions that'll change the timeline, right? So we might know what the secular trend is over the next 10 to 20 years, but for example, President Trump wants to cut taxes and decrease regulation, so that'll probably pull some growth forward and leave a problem down the road. And those are things we have to watch out for. So really, if you stick with this approach here, and I'm going to have this packaged into a much nicer PowerPoint presentation. I am not a PowerPoint expert, so I've been learning and having my son help me. But I think if you stick with this approach, I'll just tell you, this is the type of return. This is what you get.
Yeah.
You get. You kick everybody else's butt because most people ignore one or two or three of these four important criteria. How many people have no idea how to use a chart to give you a ballpark idea of something? How many of them have never heard of money flow?
Right.
80%, right?
Probably.
So, and how many think of things from top down? They say, well, I'm not a top down guy, I'm a bottom up guy. Why wouldn't you be both?
Right.
Why wouldn't you find the big trend and then the best companies within it, see how the governments and central banks impact it, and then look for some catalysts or a trend to jump on, with the pricing. So that's what I've done. There's 4 moving parts. It seems like a lot, but if you do it step by step, I'm just some kid from a blue collar neighborhood in Milwaukee, man, and I'm making money doing this.
Well, you've done good for being from humble beginnings. Possibly you've done amazing things. Those returns are very impressive. People really should check out fundamentaltrends.com just to see, not only the free materials, but what you have to offer, what you can do for people. Besides going to fundamentaltrends.com, link in the description of this video, how else can people contact you on social media and elsewhere?
On Twitter, I am at Kirk Spano. So if you want to find me on Twitter, you can do that there.
There you are. Yep.
There it is. If you're a Facebook person, there's my Fundamental Trends page on Facebook.
Yep.
And I'm starting to use. There's this new thing called YouTube. So I'm starting to put stuff up on YouTube. I need a better picture. But, the technology is pretty overwhelming. And I'm happy to connect on LinkedIn. I will tell you, again, just Kirk Spano.
Yep.
You can see from the notices, I don't check very often. If I check this twice a month, that's one time more than usual. So
very good, sir. So,
but
people should be connecting with you. They should be checking out fundamentaltrends.com. Mr. Spano, I've learned quite a bit about the oil and gas sector and how to approach it using that top-down approach, as you've mentioned, looking for the criteria, not just looking at a chart and making a quick decision, being patient with it, looking at the fundamentals. You showed us so much today. You showed me that other website. What was that website you showed us before, where you can get the news, the latest?
Stratfor. It is one of the best. I'm
gonna check that out.
Yeah, Stratfor. I tell you what, I've met Mr. Dr. Friedman. These folks are. You know who this is? These are the analysts around the world that when a company like, pick one, General Motors, Exxon, whoever, when they're looking to develop a project around the world, they come to these guys for information about what's going on the ground. And so really what this is almost like a private CIA, right? They're not blowing stuff up or anything, but they're a very good source of information that I think people, I don't get a nickel for pointing this out,
right.
But over the last decade, this has been one of the best things I've read. John Malden uses it. A lot of people use it. I've seen the subscriber list. It's an impressive website. You go here and say, okay, what do I want to read about? And themes. It's broken down pretty interesting. What do you want to read about? What do you want to learn about? What are you trying to figure out? It's here. So this is, to me, is one of the best resources in the world, along with the Financial Times. Even though I write for the Wall Street Journal Network, I'll tell you what, which is for North American stuff, you can't beat the Wall Street Journal and Barron's and Market Watch for the lead-ins.
Sure.
But the Financial Times for global, oh man,
yeah,
you can't beat the Financial Times. That's worth a subscription for any investor too.
People should be bookmarking all these. This is Mr. Spano's secret weapon you're looking at right here, Stratfor, as well as, of course, fundamentaltrends.com. And Market Watch, look for him on Seeking Alpha as well. Mr. Spano, I've learned a lot. I just need some time to absorb it now, so I'll bid you a great day. Thank you, sir, Mr. Kirk Spano, for joining me today on Looking at the Markets.
Thanks a lot, David.
Thank you for watching. Please like, comment, and subscribe. And I'll see you next time.